For like 80 years, U.S. government debt was basically the undisputed foundation of global wealth. I mean, it was the bedrock, right?
Oh, absolutely. The absolute bedrock.
But quietly, while, everyone was distracted by interest rate hikes and stock market surges and all that noise, the European Central Bank just released data that kind of proves that era is over. Today, gold has officially dethroned U.S. Treasuries.
Yeah.
It is now the single largest reserve asset category held by the world's central banks.
It is a profound realignment.
Mm.
I mean, when you look at the architecture of the modern global economy, specifically post-Bretton Woods, right?
Right.
The dominance of the U.S. dollar and treasuries wasn't just some casual assumption. It was the structural reality that literally everything else rested on. So this is huge.
It really is. And for our deep dive today, we are pulling this data, along with some really brilliant underlying analysis, from a June 5, 2026 market report. This is by Doug Young, who's a financial market researcher with over 20 years of experience.
He really knows his stuff.
He does. And this piece was published by the Gold IRA Company's Bulletin. So we're kind of pairing his insights with these latest figures from the European Central Bank and the World Gold Council. The mission today is to map out exactly why the world's most powerful financial institutions are radically altering how they store their sovereign wealth.
Yeah, and to really understand the magnitude of this shift, we have to recognize what a central bank is actually sacrificing when they pivot from treasuries to physical gold.
Right, because it's not a one-to-one trade.
Exactly. Historically, central banks used U.S. treasuries because they offered deep liquidity and, crucially, yield. Like, you park your sovereign wealth in American debt, and you get paid interest for it.
Yeah, get a steady return.
Yes. So sacrificing the yield of a treasury for a static block of gold, which pays zero interest, right?
Zero.
And actually costs money to store and secure, that completely goes against traditional modern financial orthodoxy.
Okay, let's unpack this. If they're ditching an asset that pays them money for a heavy metal that costs them money to guard, the motivation driving this shift obviously isn't about making a standard return on investment.
Not at all.
It's about something much more foundational. It's like, well, think of central bank reserves as a nation's emergency savings account. They use it to stabilize their currency and settle international debts. So let's look at the actual numbers driving this. According to the recent ECB data, gold now makes up approximately 27% of global central bank reserve assets.
Wow.
Yeah, and U.S. Treasuries have declined to roughly 22%.
And, that 5% spread might not sound massive to a casual observer, but it is monumental when you are dealing with the sheer scale of global sovereign wealth.
Yeah, we're talking trillions.
Trillions.
Well,
Trillions of dollars in value are represented in those single-digit percentage shifts.
But wait, hold on. Let me push back on the optics of that 27% figure for a second. Because anyone who tracks the commodities markets knows gold prices have just been surging, right, to record highs.
Oh, yeah. Breaking records.
So if a central bank's reserve share is calculated based on the total market value of their assets, isn't this just like a denominator effect?
What do you mean?
Like, if the gold they already have sitting untouched in some vaults suddenly doubles in price, their quote-unquote gold percentage shoots up on paper without them actually lifting a finger.
Right.
Are they actually backing up the truck and buying more metal, or is this just price inflation skewing the data?
That is such a good question, and Doug Young's analysis actually tackles that exact price versus volume distinction.
Okay, so what's the verdict?
Well, you're right that price appreciation absolutely inflates that 27% share. If gold prices spike, the mathematical weight of gold in the overall reserve portfolio naturally expands.
Right, it's just math.
But, and this is the key, the World Gold Council data reveals that the volume curve is also sloping upward. So central banks are not just passively riding this price wave, they are aggressively accumulating net new physical gold.
Even at these crazy record-high valuations.
Yes, exactly. In April alone, central banks added 17 tons of new gold to their reserves.
Wait, 17 tons? In 1 month?
In a single month. And the buying profile is geographically diverse, too.
Yeah.
We are seeing major accumulation from countries like Poland, China, the Czech Republic. They're looking at the highest gold prices in human history and actively choosing to convert capital into physical metal.
Okay, 17 tons in 1 month at the absolute top of the market. I mean, if a highly sophisticated, data-driven central bank is buying that heavy at the top of a surging market, they're definitely not bargain hunting.
No, not at all.
They are buying out of an immediate sense of necessity. So what exactly is driving that necessity?
Well, the source material identifies three strategic motivations, basically. geopolitical risk, sanctions risk, and dollar diversification.
Got it.
But the true catalyst, like the real engine, driving this behavioral shift across global central banks, centers heavily on sanctions risk and this broader concept of counterparty risk.
Here's where it gets really interesting, because counterparty risk is basically just trusting the other guy to keep his word, right? Let's break down the mechanics of that. When a nation holds U.S. Treasuries as their primary reserve, their sovereign wealth is essentially just a line of code.
The digital ledger entry.
Right, on a New York Federal Reserve server or sitting in a clearinghouse like Euroclear. It is entirely digital, and it is entirely dependent on the Western financial infrastructure.
Yeah, it relies completely on the SWIFT payment messaging system and the compliance of U.S. and European banking authorities. When you hold a U.S. Treasury, you are holding a promise.
A piece of paper, basically.
Exactly. You are trusting the U.S. government to honor that debt, and you are trusting the infrastructure to process your transactions. That is counterparty risk in a nutshell.
So it's like, okay, if you're a listener, imagine moving your entire emergency fund from a digital bank app where an algorithm or a bank manager could theoretically just freeze your account.
With a single click.
Right.
Yeah.
Moving it from that app into physical cash hidden in a fireproof safe in your basement, you're trading the convenience of the app for absolute, undeniable control.
That is a perfect analogy. And these aren't just, day trading speculations. These are multi-year strategic risk management decisions. By moving to physical gold, nations are physically extracting their sovereign wealth from that Western financial grid.
They are eliminating the counterparty entirely.
Totally. And to be clear, we're not taking political sides here, but just looking at the mechanics of modern financial sanctions. The U.S. and its allies have demonstrated that they can and will weaponize the dollar.
Right. The system can be used as a tool.
Exactly. They can freeze a foreign central bank's dollar reserves overnight, effectively cutting a nation off from its own sovereign wealth. And when other nations watched how swiftly and comprehensively dollar reserves could be neutralized during recent geopolitical conflicts, their risk calculus changed permanently.
Because holding a treasury means holding a liability that Washington or Brussels can turn off with a keystroke.
Precisely. Which is exactly why the lack of yield on gold is no longer a deterrent. Central banks are perfectly willing to forfeit that 2, 3, or 4% interest they'd earn on a treasury in exchange for absolute, indisputable ownership.
Because a physical gold bar sitting in your own sovereign vault cannot be frozen by a foreign algorithm.
No, it cannot. It cannot be sanctioned out of existence. It represents pure, off-grid financial sovereignty.
Which brings us to something really wild. This desire to physically secure wealth is leading to some incredibly volatile market psychology. The source material details this fascinating case study involving India, and it really highlights just how sensitive the global financial system has become to these sovereign gold movements.
Oh, the India story. What's fascinating here is that it perfectly illustrates this new paradigm we're talking about.
Yeah. So according to the research, this massive rumor swept through the financial markets that the Reserve Bank of India had quietly liquidated $12 billion worth of its gold reserves.
Huge sum.
Massive. And the narrative was that the Indian central bank was selling off its gold to defend the rupee. Before we get into the fallout of that rumor, let's establish the actual mechanics of what that even means. Like, for you listening, how does selling gold actually defend a currency?
Okay, so if a central bank wants to boost the value of its own currency, in this case the Indian rupee, it needs to restrict the supply of that currency on the open market.
Make it more scarce so it's more valuable.
Exactly. To do that, the central bank intervenes in the foreign exchange market. The theoretical mechanic here is that the Reserve Bank of India would sell a portion of its gold reserves in exchange for U.S. dollars.
Okay, so they get billions in dollars. Then what?
They then take those billions of U.S. dollars and aggressively buy up Indian rupees on the open market. By absorbing that excess rupee supply, they artificially drive up the currency's value.
Okay, so it's a classic foreign exchange intervention. It's just funded by liquidating the ultimate reserve asset.
Right.
But the market didn't just casually note this rumor. It caused a massive shockwave. Why did the mere whisper of India selling $12 billion in gold trigger such a violent reaction among institutional investors?
Because right now, central bank accumulation is essentially the structural floor under the global gold market. Market participants view sovereign buying as the ultimate indicator of macroeconomic strategy.
It's the confidence keeping the whole thing propped up.
Exactly. So if a major, sophisticated player like India suddenly hit the panic button and started dumping historic amounts of gold, it would signal a profound crack in the prevailing thesis.
It would mean they were desperate.
Right. It would imply that the threshold for pain had been reached and that emerging economies were being forced to cannibalize their hard assets just to maintain basic currency stability.
Wow. But the craziest part of all this, the rumor was entirely fabricated.
Complete fiction.
Yeah. The Indian government and their official fact-checking unit literally had to intervene publicly. They released official data categorically denying any sale, proving their sovereign holdings remained completely unchanged at exactly 880.52 tons.
Yeah, they didn't sell a single ounce. But, and this is where it ties everything together, what the Reserve Bank of India is doing with that 880 tons of gold is actually much more significant than a theoretical currency defense.
Right. So if they didn't sell it, what are they doing with it? The research highlights a massive logistical operation. They aren't selling the gold, they are repatriating it, meaning bringing it home. Over a period of just 6 months, India increased the share of its gold stored domestically from 66% to 77%.
Which is a huge structural shift. Historically, for the sake of convenience and liquidity, many nations stored their sovereign gold in foreign vaults, primarily the Bank of England or the New York Fed.
Because it's easier to trade.
Exactly. If you wanted to lease your gold or execute a massive trade, it was so much easier to have it sitting in London where the bullion banks operate. You just changed the name on the ledger. The physical metal itself basically never moved.
But now they're demanding physical delivery. And we just need to pause and consider the sheer logistical nightmare of repatriating sovereign gold. We aren't talking about wiring funds on a computer here.
No, not at all.
How does a country like India actually move hundreds of tons of physical gold from the Bank of England to New Delhi?
It requires an operation on the scale of a literal military deployment. Because remember, a single ton of gold is incredibly dense. It takes up very little physical space, but the weight makes standard transport impossible.
You can't just put it on a FedEx plane.
Definitely not. You're chartering specialized heavy-lift cargo aircraft. You're coordinating multi-jurisdictional airspace clearances. You require heavily armed military escorts from the vault in London to the tarmac, and then from the destination tarmac in India to the domestic reserve.
Not to mention the insurance premiums. Imagine insuring billions of dollars of untraceable physical wealth flying across the globe.
Well, the insurance underwriting alone requires entire consortiums of specialized brokers. The whole process is astronomically expensive and incredibly fraught with logistical risk.
Which honestly speaks volumes about their underlying fear. I mean, if a central bank is willing to absorb the massive financial hit of chartering cargo planes, paying those exorbitant insurance premiums, and executing military-grade security operations just to get their gold out of London.
Their fear of leaving it in the Western financial system vastly outweighs the cost of moving it.
Wow.
It is the ultimate manifestation of the sanctions risk we discussed earlier. India and all the other nations executing similar repatriation operations right now are explicitly declaring that the convenience and liquidity of the London or New York markets are just no longer worth the counterparty risk.
They want the metal inside their own sovereign borders.
Yes, protected by their own military.
Okay, so we have a landscape right now where central banks are accumulating physical metal at record highs, paying massive premiums to physically fly it across oceans, and fundamentally diluting their reliance on U.S. Treasuries.
That's the reality.
So what does this all mean for you listening to this? If you're just trying to be a well-informed person, you have to reconcile this massive structural shift with the noisy daily financial news cycle. Because, I mean, tomorrow you might see a headline screaming, "Gold prices plunge on strong U.S. jobs report," or "Treasury yields spike, gold sells off." How do you square those daily price drops with this overarching thesis? It feels like watching the weather versus watching the climate.
I love that climate analogy, actually.
Yeah.
And Doug Young's analysis provides a really critical framework for this. He says we must rigidly separate tactical volatility from structural shifts.
Right, because the daily financial news cycle is entirely focused on that tactical volatility.
Exactly. The short-term tremors.
Yeah.
Let's look at the mechanics of those tremors for a second. Gold is priced in U.S. dollars. So when a strong U.S. jobs report comes out, the market assumes the Federal Reserve might keep interest rates higher for longer. And higher interest rates make yield-bearing assets like U.S. Treasuries more attractive to retail and institutional traders in the short term. Consequently, the dollar strengthens and the dollar price of gold drops.
Because it takes fewer dollars to buy the same ounce of gold.
You got it.
Yeah.
And analysts will constantly revise their 30-day or 90-day price targets based on these macroeconomic data points. That is just standard algorithmic price action.
But those daily market tremors don't change the underlying architecture. Instead of just weather versus climate, it's almost more accurate to look at it like plate tectonics.
Oh, for sure.
The retail day traders, the algorithmic trading bots, they are betting on the daily tremors. They are trading the jobs reports and the CPI prints. But the central banks of Poland, China, and India, they are mapping the movement of the tectonic plates themselves.
Spot on. Because a 2% drop in the spot price of gold on a random Tuesday does absolutely nothing to alter the multi-decade strategic mandate of a sovereign central bank. Their objective is off-grid wealth preservation. They are actively de-risking their national balance sheets away from a weaponized US dollar. They will gladly just continue to acquire gold into those price dips, completely ignoring the short-term volatility.
So your takeaway as someone tracking this when you are reading the financial press is to just contextualize the noise, understand the mechanics of the broader international monetary order. Sovereign risk is literally being aggressively recalculated in real time.
And critically, as the India case study proved beautifully, you have to verify the data. The market is tense right now, and misinformation regarding sovereign asset liquidation will cause panic.
Don't fall for the rumors.
Exactly. Rely strictly on verified reporting from official entities, the International Monetary Fund, the European Central Bank, the World Gold Council, because they track the actual physical movement and accumulation of these assets, bypassing all the speculative noise of the daily trading desk.
It is genuinely incredible to realize that the fundamental definition of financial safety has kind of reverted back to its absolute most basic form.
It really has.
I mean, we spent 80 years building the most complex, interconnected digital financial system in human history, only to have the architects of that very system basically decide that true safety is just a heavy piece of metal locked in a vault.
Yeah, but ironically, the sophistication of the modern financial system is exactly what created the vulnerabilities these central banks are now so desperate to escape.
Right. Which leaves us with a lingering, almost philosophical question for you to consider as we wrap up. If the world's most powerful central banks, the very institutions that control the fiat currency system, that literally print the paper and issue the digital credits we use every day, if they are quietly repatriating their physical gold to avoid the counterparty risk of other nations, what does that say about the future viability of fiat currency itself?
That's the trillion-dollar question.
Exactly. If the creators of paper money are choosing to hoard physical metal instead, perhaps the definition of quote-unquote money in the 21st century is about to experience a very old-school renaissance. It really forces you to evaluate what truly holds value when trust between nations just evaporates. If you want to review the underlying data, see the structural charts from the European Central Bank, and read Doug Young's complete market analysis, we highly recommend you visit the Gold IRA Company's bulletin website at goldiracompaniescompared.com. That is goldiracompaniescompared.com. You can find a link to all of this data in the notes below this deep dive. Until next time, keep looking beneath the surface, and we will catch you on the next deep dive.